Hello friends, this is Vijay Bhambwani. Welcome to the 67th edition of the weekly market outlook video. What a week we had last week, and the kind of volatility that we saw on Monday and Friday was enough to kind of scare even the most seasoned traders. But I hope my videos are helping you navigate through this traffic of the market more effectively, and the WhatsApp updates that I'm sending you, especially the one that I sent you on explaining what is a one marshmallow and what is a two marshmallow theory on Thursday, was prescient because on Friday the markets fell. Another update followed on Friday as to why I made that video, and some of you might have misconstrued it as a repeat of that message. But I've explained the logic behind why and when I sent this 1 and 2 marshmallow theory on behavioral technical analysis. If you wish to be included in the free WhatsApp broadcast list, I have given you my cell number, the WhatsApp cell number, because I noticed a lot of you are making mistakes in BSPL India, and somebody is sending a mail to BPL India or BS India, and the mails are bouncing back to you. So here you are. You have my direct cell number, the broadcast number. Just add it to your phone book. Send me a message from this WhatsApp number, giving only your full name and, if possible, the mail ID, and I'll get you started right away. So friends, let's get into what's likely to look at in the market in the coming few days. And let's take a dive into the market roundup that you see on your screen right now. What you basically see is both the headline indices happened to fall, and mildly, and that too thanks to the decline that we saw on Friday. Bullion rose on safe haven buying. Energy remained subdued as gas sold off sharply, and oil saw a rally, but the pace of advance in oil prices seems to be slowing for now. The US dollar remained firm, which kept emerging markets, including Indian markets, under check. The rupee fell versus the US dollar due to Friday's fall in the currency markets. Bond yields eased as the RBI chose to keep the policy rates unchanged for now. The market cap of the NSE saw a slower fall of 1.38% on a week-on-week basis, which is significantly smaller as compared to the last 2 weeks. As you can see, the MWPL, or the market-wide position limits chart on your screen, this figure rose because traders raised exposure levels based on hope. The coming week is likely to be a trend determinator of sorts, as after that week, we'll start gearing up for the expiry of the February series, and I want the MWPL to rise so that the two marshmallow traders are showing their intent to participate in the market. Now, this concept of one marshmallow versus two marshmallows, I already updated you in my recent video. There is a hyperlink to that video on the top right hand side, as well as in the description column, in the description segment below this video itself. Now, the index and stock futures volume chart on your screen shows a marginal rise in index futures, but stock futures volumes remained subdued. Now, this is not desirable as the gains between Monday to Thursday were on lackluster volumes. Watch these numbers keenly because I update them daily on my social media accounts. Do connect with me there. My contact coordinates come at the fag end of this video, so that you can update yourself on a day-to-day basis. Now, let's move to the basis chart on your screen right now. The basis is nothing but the futures premium over spot, and that has fallen on both the indices on a week-on-week basis. The Nifty basis is inverted, which is the future is trading at a discount to cash, whereas the Bank Nifty just about managed to hold its head above the water. Should the basis go into inversion too often in the days ahead, it would signal the bears are getting aggressive. This is another metric which I put up on my social media account. So do connect with me on any of my social media pages and update yourself on a day-to-day basis. Now, for the most robust and reliable indicator from our in-house statistical model, the impetus chart. It shows both the indices were moving on following impetus readings, which means the volatility and the velocity was likely to ease on falling sessions, which is Monday and Friday, as well as the bullish sessions between Tuesday and Thursday. And you saw how the week-on-week close on both the indices was extremely small. So I've seen from past experience that impetus, when it is compressed to this degree, and that too over extended periods of time, ultimately recoils or expands like a spring which has been compressed for too long, which means the price will make a sudden explosive move in either direction in the coming future, which means short-term traders need to stay alert and hold all their positions with adequate stop losses. Now let's check out the footprint of the four categories of traders in the market to see what they were doing. FIIs cut their index futures shorts and raised their stock futures longs. Where the DIIs are concerned, their index futures shorts were cut and the stock futures shorts were also cut marginally. Let's see what the prop traders did. They reduced their index futures long positions as well as reducing their stock futures long positions as well. Now a word about prop traders. These guys are extremely super sharp brokers, own proprietary trades. They know who's buying and selling and at what price. So they tend to be very close to market insiders. Now let's see the most interesting aspect of the market, the retail segment. And the retail guys reduced their index futures long positions as well as the individual stock futures long positions. Now, over the last few weeks, I've seen that the retail segment is a fairly good proxy of which way the markets are headed. They are savvy enough to take positions with the mood swings of the market. So if you follow what they are doing, you can basically be on the right side of the markets. Friends, let's now go to the bond yields segment. And the bond market has been fairly prescient about giving us guidance as to where banking stocks and the bank Nifty in particular is likely to be headed. So what we are seeing on your screen is that the bond yields fell marginally because the RBI Monetary Policy Committee kept the interest rates unchanged, and that saw banks buying back bonds they were dropping earlier, which means interest rates may not be hiked till the next RBI Monetary Policy Committee meeting in April. The markets heaved a sigh of relief on Thursday, and which is why the rally in banking stocks and the bank Nifty on Thursday. The overhang now of the United States Federal Reserve Open Market Committee still remains, because any rate hike in the United States may trigger selling in emerging markets, including India. We'll know that outcome only after a couple of days. So nothing imminent out there. I'll keep you posted. Just keep watching your WhatsApp inbox, please. Now, markets may remain ranged. I'm talking of the US market, that is, till the FOMC or the Federal Open Market Committee meeting in the coming days. The Indian bond yields may have retraced, but they still remain in the upper end of the 52-week range. So the markets are still expecting higher inflation and or interest rate hikes in the coming MPC or the Monetary Policy Committee meetings. Do keep watching this space keenly, especially if you're trading banking stocks or the bank Nifty. Friends, let's now go to the US dollar index, which determines everything from commodities, bond yields, equities, and including our forex peg, the USD INR. Now, the daily chart on your screen shows an up move on a week-on-week basis, but the same was labored, and the bulls actually had to heave and hoe and push to have the US dollar index going. What we are seeing is the price is respecting the rising trend line, and the price has gained on 3 out of 5 trading sessions and closed above its 25-day exponential moving average, which is a month-long holding on cost of a bull. So the short-term outlook appears to be positive for now. Now let's switch to the weekly chart. We see a bullish candle attempting to claw higher after a prior week's debilitating, very prominent bearish red candle. The price is, however, still above its 25-week exponential moving average, which is a 6-month-long holding on cost of a bull. So the medium-term outlook remains positive for now. The 95 level is more than just a round number. It's also a crucial near-term support that bulls need to defend in case of declines. The previous swing high of 97.5 will take some very heavy lifting by the bulls to overcome again. Now, this benchmark, the US dollar index, needs constant watching because it impacts everything from emerging market inflows to bond yields, commodity prices, and equity markets also. So you will ignore it only at your own peril. Last week, I advocated a range between 96.65 and 94.25, which held perfectly well in spite of all the volatility in the US markets. The coming week is likely to see an estimated range between 97.25 on the upside and 94.80 on the downside. Friends, let's now go to the Bank Nifty, which fell 0.70% last week after gaining on 3 out of 5 trading sessions. The falls were prominent enough and pronounced enough to drag the index into a negative closing territory over the previous week. The daily chart on your screen shows the price still remains above its 25-day exponential moving average, which is a month-long holding on cost of a bull. So the short-term outlook remains positive for now. Watch this average as a rough and ready indicator of immediate trends. Now let's switch to the weekly chart on your screen. It shows a long-legged doji, which means the close and open are fairly close to each other and both are somewhat in the center of the range, more or less. This is a sign of indecision or maybe even a tug of war between bulls and bears that resulted in a draw. Follow-up action is normally needed to determine which way the prices are going to break out. A sustained trade above 39,500 is needed to keep bulls in command. On the flip side, a continued trade below 37,300 will open up possibilities of more declines. In the week before last, the index was number 4 on the most volatile counters list, and that is exactly where it remained even last week. And last week, in my video, I advocated a range between 40,500 to 37,100, which held perfectly well in spite of all that price volatility on both Monday and Friday's trading sessions. Now, this is a function of the impetus studies that I shared with you since many weeks in my videos, coupled with other qualitative features that I am going to share with you in both the coming videos and on WhatsApp. Obviously, it will be a soft launch. WhatsApp broadcast will be sent out earlier before we put them up in our videos here. So, The coming week is likely to see an expected range between 40,200 on the upside and 36,800 on the downside. Do remember what I told you about the impetus, which is being coiled like a spring and it can basically expand at a moment's notice. So, sudden large moves may occur. Continue to trade light and hold all your positions with strict stop losses, my friends. Friends, let's now go to the Nifty 50, which is the most liquid and low impact cost derivative counter on the NSE. And as your daily chart on your screen shows, it fell on 2 out of 5 trading sessions like the Bank Nifty itself. But the falls again were severe enough to log net losses on a week-on-week basis. The price fell back below its 25-day exponential moving average, which represents approximately 1 month holding on cost of an average bull, which means the short-term outlook is under pressure for now. Now switching to the weekly chart, we see a long leg doji just like we saw on the Bank Nifty. Only difference is the Bank Nifty's weekly chart saw the price above its 25-week exponential moving average, whereas the Nifty's weekly chart shows a breach of the 25 exponential moving average, but a closing slightly above it. Now this 25-week exponential moving average is a 6-month holding on cost of an average bull. So where the Nifty is concerned, even the medium-term outlook is precariously poised. It's touch and go in either direction. The bulls will get back in control only above the 17,850 mark on a sustained closing basis. On the flip side, staying below the 16,600 mark leaves the possibility of further downsides open. In the week before last, this index was number 11 on the most volatile list, but it rose 1 notch last week to close at number 10 on the most volatile list because the intraday moves got sporadic. Last week, I advocated expected range between 18,150 on the upside and 16,850 on the downside, which again held perfectly well in spite of all that volatility which you saw on Monday and Friday. In the coming week, I expect a range between 18,000 on the upside and 16,700 on the downside. Friends, remember to trade light and hold all your trades with stop losses diligently. The Jensen's measure, which I have explained to you in my past videos, a favorite risk measure of savvy hedge fund managers, is warning about a challenging scenario for bulls who are taking leverage positions. So as far as fresh leverage positions are concerned, please do trade light, hold all your trades with stop losses, and make haste slowly. That means go slow. Friends, the index segment done. I now go to the most popular segment of this video, wherein I give you 5 stocks, high impetus, high beta, where you take small exposure, wait for large price moves, and 5 stocks which are low beta, low impetus, where you take big exposure and wait for small price moves. Why the difference? Different traders, different techniques, different attitudes, different aptitudes, and therefore different strategies. So the high beta, high impetus stock list where you take small exposure, wait for large price moves is led by Gujarat Gas at number 1, GNFC at number 2, number 3 Crompton, number 4 India Bulls Housing Finance, number 5 Petronet LNG. Where the low beta, low impetus stocks are concerned, the list is led by LIC Housing Finance at number 1, number 2 Torrent Pharma, number 3 Canara Bank, number 4 SBI, and number 5 Axis Bank. Friends, the hierarchy of these stocks can keep changing day to day, even hour to hour. So do connect with me on social media and stay updated with the kind of statistical information that I share with you. I assure you it's not intimidating. A secondary school child will be able to understand what I'm trying to convey across. And then, of course, you always have WhatsApp access to me. Give me a shout. And we'll get you clarified on issues. So friends, before I sign out of this video, a reminder, please subscribe to my channel if you haven't already done so. Click on the bell icon to receive instant alert about fresh videos being put up out here. And do click like on this video if you liked what you saw. I'm eager to hear from you. So please keep the comments coming in the comment section and help me reach out to fellow like-minded investors and traders who are looking out for knowledge-based investments and trades by referring my video to your family and friends. Friends, I thank you for your patience, but please do check out the description segment. There is a hyperlink to my YouTube channel, my playlist on Equity Masters YouTube channel. Do subscribe to that channel as well and avail of a free PDF guide, which is again given in a hyperlink in the description below. Thank you for your patience and watching my video. Stay safe from the Omicron virus. Till we meet again in my next video, this is Vijay Bhambwani signing off for now. Have a very, very profitable week ahead. Thank you.